Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. Very exciting show. I've got more questions for our guest, Scott Bok, today, and I can't wait to dive into this. He's got a great new book out we're going to talk about. We've got a very broad landscape we're going to cover that will have nuggets and diamonds you can take with you. Remember to like and subscribe to the channel. Hit your notification bell so you know when new episodes are released. And if you have an interest in making a quantum leap in your investing education, skill, temperament, becoming an investor, not just a participant in the market, check out yourinvestingclass.com. That's where we start people off with free resources and make that quantum leap. Today, my guest is Scott Bok, and this is the closest I'll ever get to the Wharton School of Business. That's where he went to school. I think they probably have a restraining order because they lose their IQs to me through osmosis. So I'm kind of a vacuum that way. But he's done a lot of work in M&A, merger acquisitions. I'll let him talk about his resume. It's a mile long. But Scott, welcome to the program. Thanks for taking some time to share your experience with us. I think it's going to be fantastic.
It's great to be here, Andy, and I'm excited with some of the stories I can share with your guests, your listeners and patrons.
There's going to be some insights. The name of your book, let's just right at the top, it's Surviving Wall Street, A Tale of Triumph, Tragedy, and Timing. And we're going to dive into a lot of what, that first idea of survival, what it takes and how people do survive and even thrive with ups, downs, sideways. But before we get into the book and the lessons we can draw from that, let's start with a little bit of your background. Scott, how did you wind up, getting into this business and getting interested in M&A? How does a guy whose dad is a blue collar worker, grandson of immigrants, get into the Wharton School of Business? Let's start with that story.
Sure. Look, I grew up in small town Michigan. Father didn't graduate from high school. Mother was very young. No one in my family had gone to college before. But I did well in school. My parents wanted, me to succeed. And so they encouraged a good education. And I went to Wharton literally because it seemed to me, as a person with a family with no experience in college, is the most practical of the alternatives. I mean, that wasn't like majoring in English at Princeton or going to major in some other field where it wasn't clear to me what the connection was. But I felt like Wharton is a brand that that would help me in life. And so I went off there knowing really nothing about Wall Street, and that really is kind of the main rationale for writing this book in the first place. Is when I graduated from Wharton in 1981, the world was a very different place, and Wall Street and investment banking were tiny. I mean, on the day I graduated college, the Dow Jones was under 1,000. It had first crossed 1,000 more than 12 years earlier. I mean, it's in today's. I mean, people in their 20s, 30s, 40s can't even imagine, gosh, you went more than 10 years with the market going down, but that's what happened in the 1970s. On the day I graduated, the federal funds short-term interest rate was 20%. I mean, we're used to being 0, 1, 2, 3. It was 20%.
Yeah.
So it was a pretty grim time, and Wall Street was a very, very small place back then. Even graduating from Wharton, I had no idea what an investment banker was. I knew only one person in my entire class who got a job on Wall Street. And so, it didn't exist, but I sort of found it. It became a big business really starting in the 1980s, and I was fortunate to find my way in.
You talk about the change in the market and how it has evolved. I don't feel like I'm an old man, but I'm not a spring chicken. But my son, he's in high school, and he said, "Dad, do you think, he's really obsessed with Warren Buffett and the age." He says, "Where do you think Warren was when he was my age?" I go, "Well, he wasn't writing covered calls because there wasn't even an option market for him back then." And, you talk about the 70s, where we go off the gold standard, and then we have some inflation, and poor Carter's got energy problems and hostage problems and massive inflation problems, Paul Volcker trying to keep things under control. So it really has changed. And when you talk about the dynamics, things like M&A, the derivatives that we've invented since then, and you talk about these five events And if a person can get a grasp of these events and learn from them, and what I don't want to borrow your phrase too much, but there's a Darwinian limbic, where it's,
Hmm.
if you're on the Starship Enterprise, you want Spock to do the trading.
Yes.
Doctor McCoy's chicken, and Kirk is overconfident. It's all like we're going to get these Klingons, and the chance of survival 10,000 to 1, and Doctor McCoy will say, Jim, you can't do this. Do you need a sedative? He says, I'm going down there anyway, and Spock is just even keel. And I would tell you, in my opinion, and I don't want to extrapolate. I want to know what the author has to say. But when I look at those 5 events, and you can list what they are, those are the life-changing buying opportunities where, if you understand the Darwinian psychology, you can understand the detachment between stock prices and value in a company. And that detachment from fundamentals can really overvalue things, and they can really undervalue things. And when a person, Buffett, in his 2021 letter, he literally called it the shooting fish in a barrel experience, where you have this massive array of really good producers of business and goods and services that you just pick them up, you back up the truck. So let's talk about those events,
Sure.
if you want. And I want to get you, that's my perspective, but they're
Yep.
more interested in your perspective than mine.
Yes. Yes. Yeah. So let me just set the stage a little bit, and then I'll talk about those five sort of crises that I talk about quite a lot in the book. I mean, again, when I graduated from school, Wall Street, very, very small. Think about this. Like, there was almost no M&A back then. Almost didn't really
Yeah.
exist. I mean, it's not a thing people really heard about. The phrases private equity, hedge fund, activist shareholder, none of those had been invented yet.
Yeah.
And now you roll the clock forward to, where are we today? Today, there's trillions of dollars of M&A every year. Private equity owns 30,000 companies worldwide. The Wall Street pervades every aspect of every business sector, politics, sports, all the rest. So we've come a long way. But the other thing I noticed, it's a story of extraordinary growth, that 40 years. But the other interesting thing is that Wall Street firms, the ones that existed when I started out, a large majority of them are long gone. Right, and you'll know a lot of the names. We all know the Lehman and Bear Stearns and so many.
Bear
There's Drexel
Stearns,
Burnham
yeah.
and Kidder Peabody and Payne Weber, and there's just dozens and dozens of firms that didn't make it. And so, like, why did that happen? And that gets to your question about the 5 crises I talk about in the book. So, and our firm was an independent firm before we sold for about 25 years. And in that 25 years, there were 5 real crises. There was the collapse of the long-term capital hedge fund in the late 1990s. There was the dot-com bubble bursting in the early 2000s. There was the global financial crisis in 2008 and beyond. There was the pandemic. And then
COVID.
I think, in some ways, the one that's kind of the trickiest to name in a pithy way, but in some ways it was the most troublesome, is the combination of COVID recovery with the Ukraine invasion, because the combination really spiked inflation, higher interest rates, and all that. And those crises, I mean, we all know markets are cyclical, but the cycles act as almost like a tidal force. It's a time to sow, a time to reap. There's a time to make money, there's a time to get out. And the crises tend to mark the turning points. And those are the turning points in a corporate sense. I mean, that's when, Lehman disappears. That's when Silicon Valley Bank disappears. That's when Credit Suisse gets forced into to merge and with
Yep.
UBS to keep alive. So
Yep.
those crises, which are something you have to learn to manage, whether you're running a big business or whether you're running your own career or even your own investments, they mark the key pivot points that you've got to look for. And I use a phrase. You mentioned Warren Buffett. I used a few quotes from him in the book, and one of them, which is one of my favorites on this topic, which is that in the short run, the market is a voting machine, and in the long run, it's a weighing machine. And what he means by that
Interesting.
is, in the short run, it's driven by emotion. Who gets the most votes? Who's there? Where's the most excitement behind? What's the hot thing? Obviously in the dot-com bubble, or maybe recently again with the Mag 7, there's a particular sort of fervor behind a certain group of companies. But his point is, that's the short term. It's based on emotion. It's based on, the booms and busts and investor psychology. In the long run, it's a weighing machine. In other words, in the long run, the market will really reflect what something is worth. So if you can, when you're managing a firm like I did for a long time, running a firm that was a specialist in mergers and acquisitions, and did some private equity things and other things as well, or really whether you're managing your own career or your own investments, if you can sort of keep the level head, realize that okay, today the markets, it looks like it's going crazy. It's a voting machine, but what's the real value? What's the real opportunity? How much risk can you take? And you always find in those crises that it's the firms that are a little too far out over their skis, taking a little too much risk, a little
Yep.
too levered, that end
Yep.
up suddenly they disappear. So that's a big part of the book, is kind of the navigating those five crises.
I'll tell you why I would recommend. There's a lot of reasons to buy this book, and it's available on Amazon, of course. Quality bookstores everywhere. Surviving Wall Street: A Tale of Triumph, Tragedy, and Timing. In every one of those that you mentioned, it's funny. As I got older, I've gotten better at making money with these tragedies. My best ever. Well, we did some cool things with the Ukraine, but my best ever was COVID for sure. Because each one of those crises, I mean, I've changed my attitude. Each one of those sales, I've had a different attitude towards. Long-term capital management is interesting. Their lawyer was Jim Rickards, and I know Jim a little bit. I've had him on the show, and he and I have done events together where we've both been on the docket to speak. And it was really interesting. I think that the thing the long-term capital, they go to the Fed, and they said, hey, we're in trouble. And the problem with us being in trouble is, our liabilities are assets to other people. And so we have this idea of a toxic asset now, because if they go down, and these guys, their assets are going to, and there's a domino. And it was really interesting because they just thought they were going in there to say, hey, we're just giving you a little courtesy call, heads up. They weren't really asking for help, because at the time, the Fed wasn't in the bailout business so much as they are now. You look at Silicon Valley Bank, they changed rules over the weekend after
Yes.
Silicon Valley Bank went down. But if you learn about what happened with those guys, like you said, they got over their skis a bit, tide goes out, and we found they were swimming naked. So that's a great lesson, because there's a sense that Wall Street is more intellectual than emotional, and that is absolutely not true. You have a Nobel Prize winning guy that won a Nobel Prize for developing the options trading model that we use today. We don't have an options market open in '68, early '70s without Black and Scholes. So everyone's
Right.
saying, "Oh, these guys are brilliant. We got Nobel Prize winning economists, math guys doing this." And it was incredible, and it started change. Every single one of these recently, the Fed has expanded their powers, so that's a good lesson. When you think about the dot-com crash, 9/11 kind of gave that a little bit of juice too, I think.
Yes.
But in that one, I like your thoughts on this. There's a feeling I got in that '90s that is reminiscent of today, where instead of talking about how much money we're earning, we're talking about how much money we've raised. And instead of talking about what our managers are doing now, we're talking about some serial entrepreneur that did something somewhere else. I remember in the '90s, no one was making any money. It was all about the internet and the potential and how much capital we've raised to take advantage. I feel a little bit of that with AI now. Do you feel that? I feel
Look,
like
yeah, there's an awful
do you
lot of
feel that?
enthusiasm behind it. Yeah, that's true. That you do get these, the market of voting machine, and a lot of enthusiasm for these hot sectors. The other interesting thing, though, when you think back to that long-term capital situation, and
Yeah.
and then even the dot-com bust that came just a few years after that. I mean, it was interesting. It was 1996 that Alan Greenspan, then chairman of the Federal Reserve, made the comment that the markets were irrationally exuberant. It became a big
Exuberant.
phrase,
Yeah.
irrationally irrational exuberance was
Yeah.
a common thing. But the dot-com bubble didn't burst for more than 3 years beyond that. So the market,
Yes.
these cycles, it's real. That's what's interesting in the book, and just to take a step back and look at the whole 40 years and see sort of the grand sweep of these cycles. It's not easy. It's like Greenspan thought, wow, these markets are overvalued in 1996. Well, from there they went up in 97, 98, 99, 2000. Finally, in 2000, it peaked in March of that year. And so there definitely is this tidal impact that eventually gets to a kind of a crescendo where you end up having a real crisis. And the firms and individuals that are too overextended, they get washed away. And that really is where most of these Wall Street firms that have disappeared over the years, it's been because of those moments. You think about Lehman, you think about Silicon Valley Bank, back in the day with Drexel, Kidder Peabody. I mean, there have been many, many examples
Let me
where they
ask you
just get caught
about
in the wrong side.
Let me ask you about that then. So he uses that term irrational exuberance, and Robert Shiller takes it and writes a book and titles it exactly. And Shiller comes up with his little Shiller PE, and it's 120 years probably inflation adjusted graph of what's the PE adjusted of the S&P 500. What do we get? You want to get $1 earnings out of the S&P. What does it cost to buy that machine?
Pay for it? Yep.
Yeah. You look at that today, I imagine it's probably 31, 32. It's only been this high one other time in the dot-com bubble. And it's really, in that 120 years, you've probably got about 7 years where it's been this high. So what that really means is we're paying more for earnings than we normally pay. We're just paying a lot to make $1 of earnings, which is a fundamental. And when that happens, it's because people think things are going to grow. There's an exuberance for growth. So can you draw a parallel? Because, like you say, in 96, well, how much more one way do we have before we're paying just like insane prices? Do you see a parallel today for that?
Look,
do you feel we're irrationally exuberant?
Maybe we're a couple of months ago. I think the people are a little more worried right now. But look, I'm not an investment advisor, but I am sort of a historian. I mean, I've read all the books that are like mine that covered periods going back to the British merchant banks of Victorian England and the House of Morgan through the Great Depression and all the rest. And that's going back again to the crises and the cycles. I mean, our firm in about a quarter century, there were five crises. Those crises were not 1 year things. They were generally, I mean, some were a little more accelerated, but they were generally multiple year things. So, so at any given moment, you're never more than a few years away from the next pivot in the market. And, and we really haven't had one since COVID, right? COVID, you pointed out that the Federal Reserve really began getting into these things in long-term capital, and every succeeding crisis, they've got more aggressive, right? And so
particularly '08, yeah.
That's right. So interestingly, if you think about it, you had in the dot-com crash, and putting aside NASDAQ, which went down 80%, the S&P 500 fell in half, and then in the financial crisis, it fell in half again. In COVID, it looked like it was going to fall in half again. I mean, it fell like a rock. It was the steepest fall in Wall Street history. But you had the absolute spigots opened up in terms of both monetary and fiscal policy, and that's what braked it. And suddenly it took off like a rocket after that. So that last crisis was really kind of truncated by aggressive Federal Reserve and fiscal. Remember, everybody could get a loan. Everybody, it was kind of like Ben Bernanke once talked about the concept of helicopter money. Like if you really want to stimulate the economy, you can start pushing $20 bills out the helicopter and let them drop on the crowd below, and they'll start spending again. So we can't be that far away. But the thing about crises is you just never know where they're going to come from. I mean, long-term capital's roots were in Russian debt. The financial crisis roots were in the U.S. housing mortgage market. The pandemic, obviously kind of a one-of-a-kind thing. So each one comes from an unexpected place and an unexpected time. But if you're at a moment when prices are high by historic standards, it can make it even more severe when those crises happen in terms of the kind of downdraft you can get.
I think that being prepared, I think, you read a book like yours and you start to study those 5 different dips. And I think what happens is you get a better savvy and sense. If you look at the timing, I mean, back to the 90s to long term, that's a long time to have to learn those lessons. So if you can read a book like this and compress that, like I backed up the truck in COVID because I'd been through these cycles before. I knew what the Fed would do. And we don't have an income disparity in our country as much as we have an asset disparity. Places like BlackRock, places like Fidelity, places like Vanguard, these guys, like Vanguard's going to pull a certain amount of everyone's 401k they hold every year. That just stacks over the decades. That's why they own everything. They take those people's assets in the name of advice, charge them, even if it's 1%. That's enormous headwind to compounding. And so they start to accumulate. Well, the beautiful thing about helicopter money is I'm a huge fan of that, because if I own everything that is being sold at Costco, all that money goes to me. Oh, it goes to them initially, but they don't own the production. And if you own the production, it's gorgeous. And when there's a crash, that's your chance to own more production. And helicopter money forever, because they're gonna spend money on my iPhones and money on my AT&T network and money on my Kraft Heinz and money on my Costco. And all that money gets sucked into ownership. So it's not they helicopter money in the name of trying to solve income disparity, but that if you follow the cash flow, it's going to wind up in the pockets of the owners. The other part of this is you and I would be a pretty good 1-2 punch. If you can learn cycles, and learn how these things work, and then you understand how to trade and how to invest as an investor. I'll give you an example. Ukraine. Okay, we know that's going to cause turmoil. Well, how do you make money on that? This wasn't a large position of my mind. It was more fun than large. But one of the things I did is you see all those Russian indexes starting to fall, and insurance is getting expensive. Volatility goes up, prices of puts go up. So me and one of my teachers, we sold all of these puts at like $1 strike. And okay, say it gets put to us. Well, now I own Russia for $1. There's no downside there. It's $1. But I said they're going to halt trading, and those guys are going to be stuck with whether to put that stuff to me or to eat it, and they'll probably eat it. And that's exactly what happened. So if you can see that's not a tragedy, that's an opportunity. I don't know I don't know if that's blood money, making money off war or not, maybe, but every one of these tragedies that you talk about, or opportunities depending, if a person knows where to position themselves, they can do really, really well. I mean, when oil was free in COVID, trains, planes, and automobiles stop, and oil's free. Right. In fact, they're paying, it's negative. The future guys that don't want to take delivery, the speculators, like, I can't go to Cushing, Oklahoma and buy this oil I've promised to buy in the future. Who will buy this future from me? And the guys that take delivery say, well, not me, unless you want to pay me to take it off your hands. And I'm like, well, oil's not going to be free, dude. ExxonMobil is in the low 30s, and they paid a dividend for 30 years in a row that's been risen. How do you not back up the truck and load up on a company like Exxon that's going to borrow money to pay the dividend to keep that streak going, and own one of the best energy companies in the world when oil's free? So it is the combination of when everyone is selling to find out where you buy. So that's the first thing. And that's not going to change. That's not going to change because you use the term, it's Darwinian. I don't care if you're Black-Scholes and you have a PhD and all this. Those guys did that stuff and got over leveraged because of emotion and greed. It was not wise to do, and that is a huge lesson. So I'm glad we had a chance to. Anything else you want to say about the Darwinian nature of Wall Street, where success is short-lived and failure can be sudden and brutal?
Yeah, that's a great line. I remember coming up with that. Look, I think What you talk about as an investor, and you're a professional investor, and I've been more in the corporate side of things, but both
Yeah,
sides you can learn an awful lot from history, and I think when you're going through
huge.
either a traumatic time or a euphoric time, either one, the really bad or the really good, if you have the ability to put that situation into the context of history, how is it different than long-term capital or financial crisis or but how is it similar to, and kind of make your judgment as to where things stand then? Because I think you'd be interested. I have in the book I talk about how these crises, they're all different. They come at different times from different places,
Different
Russia,
reasons.
mortgages, et cetera, different reasons. They're in some ways you'd look just take a from a distance look and see they're all different, but they do follow a certain pattern. They come from a place you don't expect, but it's
Yeah.
very quickly investors will come around to think, well, everybody should have known that. And I mean, it's amazing how people do the revisionist history and think, well, of course, we should have known that. I mean, even in the
Should
dot
have
com
prevented
crash,
9/11. Yeah.
well, but, Greenspan said it was irrationally exuberant. We all should have known that. And so you get this thing where people figure they didn't expect it at all. Then it happens. Suddenly they think, well, it's obvious. Everybody should have seen it then. But then you have this moment where people think it's going to be, and you hear this phrase a lot, the end of the world as we know it. And, even like long-term capital, one of the things I found fascinating when I looked back and was doing research to write up that, which I remembered, but wanted to learn, or bring back more to my recollection. Six in retrospect, I mean, that seemed like nothing versus the global financial crisis of '08 or the pandemic or some of the problems
Yeah.
we've had since. It didn't seem like that big a deal. 6 months after that occurred, Time magazine had a cover story and it had a picture of Alan Greenspan, Larry Summers, still obviously in the news today, then senior economic advisor, Bob Rubin, Secretary of Treasury. The title was "The Committee to Save the World." I mean, that gives you a sense of how people came to this kind of the doom mongering of thinking, boy, I didn't see this crisis coming. Now it's here. Now I realize I really should have seen it coming. And then you have this point of maximum pessimism where people think it's the end of the world as you know it. And that's the moment when things honestly typically start to turn up. That's when, and often with help from the Federal Reserve, with each passing crisis, they seem to get even more and more aggressive about stopping, things from getting too negative. And then, things turn up, and then, but the amazing thing about investors and markets is that as soon as the upturn has come, they sort of forget about the whole crisis. It's like, and I think in some ways that's why so many investors, so many companies never really learn anything because you go through that crisis and then when it's over and it turns out to be not the doom and gloom that people were predicting, you kind of forget about it and many people don't learn the lessons. But if you study history, maybe you can take away the lessons and make yourself a better manager, a better investor, and so on through that.
I think that's the point of your book. I think that's why
Hmm.
people buy it. Surviving Wall Street, Tale of Triumph, Tragedy, and Timing. Well, if you can take a journey like yours and see how these things evolved, it prepares you where you gain experience by compressing time in history rather than observing it over a 30-year career. It'd be nice to be able to
Yes.
do it, when you're younger. Talk about this. Let's shift gears just a bit. I thought this was an interesting observation. Is when people think about M&A, derivatives, all of these new instruments, Wall Street, Wall Street, Wall Street. But you talk a little bit about the spill. I don't know what the good word for it is. The involvement in other places, and you mention academia. And I thought that was an interesting insight. Could you expand on that a little bit? Of you're done with Wharton, or you're off doing stuff.
Mm.
Why does that matter? Why does it matter that Wall Street would begin to put their tentacles into those places? Of we can talk
Mm.
about politics too. That I can see, but
Yes.
why academia? Why academia?
Well, academia, I think, drives so much of our culture. What people study, what they believe, what they think about, what their biases are, how they think America fits into the world, how they think America should be run, and so on. And so, along with my career of being CEO of Greenhill for 16 years and advising innumerable clients and their boards on M&A deals, I always was somebody who got very involved in nonprofits as well. I was chair of a board for an educational-oriented one here in New York City. I later became chair of the board of the University of Pennsylvania's Board of Trustees, and I'm still today the chair of the board of the American Museum of Natural History.
Museum.
Right, which people will, if even if they haven't been there, will remember from the movie Night at the Museum some years ago. And so, I enjoyed that. And I think in some ways, the differences between the nonprofit and the profit world are not as great as some people think. I mean, it's still the same. You're still running a big business. I mean, a big enterprise, very complex. You're dealing with regulation. You're dealing with economic cycles. You're dealing with, how to balance a budget. And so it's very, very similar. And I was involved in the last two chapters in my book, which is generally about the whole history of Wall Street, kind of seen through my eyes as I went through all these crises, both for myself and on behalf of my clients. It ends with the story of what happened in kind of a controversy at Penn that really marked the beginning of what has turned into a nationwide, kind of debate about what the elite universities should look like and what role government should have, what role big donors should have. A lot of those big donors come from Wall Street, which is where Wall Street and the
Gets
universities
in
come
there.
together. So that's kind of a pretty riveting tale, I would say, at the end of an odyssey of a young man who kind of came from nowhere, made his way through Wall Street, rose to a pretty high level, was involved in a lot of really interesting and dramatic things, often with very large clients, to also get onto kind of an adjacent stage with one of America's great universities and try to help it kind of find safe passage through a storm, the same way I often help clients try to find safe passage through a storm in the financial markets.
You made mention that it's a business, and I don't know if I'm right on this because this is more speculation. I mean, data to back this up. It's just kind of my gut feeling on it. But what would happen to prices? What would happen to home prices if you put down a scepter and said no more going into debt to buy a house? You have to come up with cash. What would happen to the prices of homes? Well, my opinion is they would completely drop like
Collapse would be
more
a good
than a
word.
rock. Okay,
Yes.
and so demand is fueled by not just desire but ability. In other words, part of the reason we had a collapse in '08 is we gave people the ability to match their desire, and there was no barrier to entry. We had a zero down. Think about this. What is dumber financially? What is dumber financially than a stated income, no doc, zero down loan? I'll tell you, there is a loan that is dumber than that. It's called a student loan. Because at least with a zero down, no doc stated income loan, you have some kind of collateral. These guys don't even have a job yet, let alone collateral. So all of a sudden you say, hey, let's provide ability to match desire for college. And what happens to the price once you give people the ability? And I think one of the things that's really important for young people to think about is to understand dogma that can surround this, because like you said, I saw my degree at Wharton as being something practical. I couldn't get connective tissue in a philosophy degree, and I think, I think young people really need to think about this now strategically with the cost. My son is lucky. He's very much unlike his dad in that he's a 4.0 student. Me, I was just trying to stay eligible to play basketball in college. And he was fortunate. He's a little taller than me. I'm 6'8". He's closing in on 6'10". So he's going to get his school paid for, and he got a scholarship. But one of the schools we were looking at paying for, we went back to the MIT camp and all of those D3 schools in Massachusetts. And I remember they some of those, and Ivy Leagues don't give scholarships necessarily. So it was interesting that they were talking $300,000, $400,000. And I said, son, if you know anything about compounding, you'll never make that up in a salary if you compound that money. So it's really important, I think, for young people to understand and read a book like this to get a sense of where academia now is fueled and the rhetorical nature of it rather than the veridical nature. You know, Veritas above Harvard is about truth. Oh, that's not, I mean, come on. That's not even, that's ridiculous. So there's a lot of power there. And I think that's why Wall Street puts their tentacles in there, because you can control things and influence things and pick the very best. I mean, that's a big deal. Let's talk about this. Greenhill was able to succeed as the David up against the Goliath. Can you talk a little bit about that?
Sure. I mean, what's interesting?
I want to bring down a Goliath. Show me that. Show me that formula.
No, everybody loves the David and Goliath metaphor, of course, but you know what I saw in my early career is that there was this massive consolidation, a whole series of mergers that created very large financial institutions. Before that, they were more specialized and regional, and didn't have all the broad range of products. But there was this huge merger wave that created the J.P. Morgans, the Citibanks, the Deutsche Banks, et cetera, that came to really dominate this space. And our firm, Greenhill, was set up as kind of a throwback to an earlier era. And we went to clients, and part of our pitch was, you don't, to do it, get help on an important, maybe the most important deal of your life, a merger and acquisition deal of your company. You don't need 1,000 people. You need a team of, a half dozen people who are skilled and hardworking and have your interest solely in mind. And so we kind of pitched David against Goliath, and it turned out a lot of clients didn't love the idea of the one-stop shopping, the firm that had the 23 different products and wanted to sell all of them to you, the firm that was a little more impersonal maybe in terms of how they dealt with you. And so we had this, we were literally 100 people when we went public. We did an IPO at a $500 million valuation on the day the IPO was completed, but we were going against firms that had 100,000 people. So 100 against 100,000. But, as I say in the book, David won more often than you would expect when we went out to try to win important client business to do some, the next big deal for a major company in America or around the world. And I think, it probably applies really to any industry that, if you come up with a strategy that's a bit different from what everybody else is doing, and you have, you really believe in it, and you build a team that's got incredible esprit de corps to try to drive that forward, David can beat Goliath, and the history of our firm is really testament to that.
As an investor, why do I care about that? I mean, someone listening is going to say, well, Andy, I'm not in M&A and I'm not in these big deals. Why do I read this book? I'll tell you why I would study this. Warren Buffett, he's probably the guy that, he's definitely the guy that I spend the most time reading about and watching. And he talks a lot about the moat. And when people say, well, I understand what a moat is, it's protection of the castle, but they often don't have connective tissue, what that looks like in a business. Like, okay, if I have to look at actual business, what does the moat look like? And I don't know that I found his perfect explanation, but I'll tell you, and I don't want to put words in Buffett's mouth, but I'll tell you what I think it is. I think it's the quality of work the company does. If you look, like take a company like Coca-Cola. People think that risk management, if you're a technical analyst and a trader and you're on CNBC, you think risk management is about the price of Coke fluctuating and you're scared the price of Coke will go down. But if you're a fundamental analyst and you get on the other side as a business owner, you're really saying, does Coke have a nice moat where it can survive assaults on the castle? They're not worried about price. They're worried about viability. That's a huge threshold of saying, like you talk about, everyone thinks the end of the world. Well, a 50% drawdown is not a 100% drawdown. Buffett's lost 48% a year before. Late Munger said, if you can't handle a 50% pullback, you shouldn't even be in the business because those assaults come. But if you look at Coca-Cola in 1886, that's before I was born, it survived World War I, World War II, survived the Vietnam War, slight inflation in the 70s, cola wars in the 80s. They survived the Pepsi challenge, Michael Jackson lighting his hair on fire, trying to get people to buy Pepsi. Dot-com bust, global melt. You can't kill it. 2 billion drinks a day, you can't kill it. So the quality of work. Well, if you can find a David, you can see what a David looks like, and you can see those 100 guys. You're like, wow, 100 guys, and a lot of overhead there, 100,000, a lot of overhead there. And you can recognize a quality of work that is unique. He bought Burlington Northern. Why? Well, 40% of the nation's freight is railroad. They're the biggest one. It would take $500 billion to build an equivalent railroad to compete. If you have a quality of work, that's where your risk management is. And if I can study what a David looks like, right, and I can see those 100 guys, that's where I get behind them and we win. Finding things that are small is hard to do. It's almost easier to short GM when they know we know they can't pay their pensions and they have to go bankrupt and restructure. It's almost easy to see the big guy teetering, long-term capital management all screwed up.
Yes.
It's hard to find the small guy. So if you can look at all these small guys and say, well, this is nobody, but there's a David right there. There's a David. You hop on that, and you don't get to be in the initial public offering always. But if you see that early, would have been nice to pick up Google at 85 a share, wouldn't it have? So I think the David and the Goliath is important as an investor.
Absolutely. Sometimes you want to think, because I love that analogy Buffett has about the moat, but you also want to think as a business person or investor, like what are their weaknesses? Sometimes it can seem like when we were looking at all these big, global investment banks, they had a big moat. I mean, they were huge balance sheet, huge resources, full suite of products for sale. You think, well, that looks almost impenetrable. But what's the weakness? Well, the weakness is maybe it's so big it's a bit impersonal. Maybe it's so big they try to cross sell all these different products and the clients don't love that. Maybe if I went in with kind of a niche specialist, we're just here to do one thing. That's to help you with your big deals that you're trying to get done. And it's a tight teams. We're not trying to cross sell anything. We're a very personal sort of service. And I'm sure there are equivalents across other industries where somebody finds that weakness. They find what is okay. The big guys have got 90% market share, but where's the weakness in that you could go in and chip away at that? And many great American companies, including ours, we're born that way.
It's interesting if you look at warfare. You look at an aircraft carrier in the ocean. Just power and bombs and planes and power. And then you look at a little speedboat next to you and you think, well, what's the advantage? I go, all right, about face.
Yes.
Turn it. Okay, great. How about a drone that's the size of a little drone that's the size of a quarter now that can go spy? I mean, it's really about the work that it can do, and size matters. It can be nice. But, I know when I was playing basketball, I remember our center got hurt once, and I had to shift from the 3-man to the 5. I thought, man, this guy's 310 pounds. He's 7'2". What am I going to do? But the thing is, I was quicker,
yes,
and I wasn't, and I was something he wasn't used to. Right. And so all of a sudden it's like, wow, I'm dealing with something new. So Davids can beat Goliath, and if you can learn to spot those, that's a big deal. Well, you've been very gracious with your time. Tell me what else. Why would you think a person should go out and buy this book right now? What do you have in there that I haven't hit? Why should people buy this book?
Well, there are a few things that make the book very relevant right now. For one, that 40-year period of explosive growth in many ways was a period of globalization. That was the formation of the European Union, the fall of the Berlin Wall, China enters the World Trade Organization, the trillions of dollars of M&A. It creates global enterprises. So it can help you think about what happens in a world where we're drawing back from that. Two is that it's really the story of navigating crises. There are 5 detailed crises. We touched on those to some extent. And look, we can't be that far away. We may even be in the early days of one. It's hard to tell. Very volatile markets right now. So I think it's interesting in that sense. And it really at heart, it's a book about leadership and how companies and individuals get through difficult times. And I think we're in a period where I think a lot of leaders are in pretty uncharted territory, trying to think about how they handle a pretty volatile economy, big changes in politics, big changes in international trade and relationships. And so I think a number of the history lessons that are taught by this book are pretty relevant to the spot we're in right now.
I'll tell you why. There's another reason I think people buy this book. It's called Surviving Wall Street: Tale of Triumph, Tragedy, and Timing. And the reason this is important is I actually do think we're on the cusp of another big one. And what I would do as I read it, if I were a listener, is Jeff Bezos said something really, really good. you mentioned, Scott, that almost every time in hindsight we say, well, we should have seen that 9/11 thing coming. Look how vulnerable we were. How could you not have seen that? Whose fault? Let's point a finger. But usually when people say, Andy, what are you worried about? What do you think the next catalyst is going to be? What catalyst do you worry about? Is it illiquidity in the bond market? Is it a Ukraine? Is it a Taiwan conflict with China? You can go down this list. I go, well, the one that I am most concerned about is the one I can't see coming. It's the one I haven't thought about yet, because that's usually the one that it is. Yes. So on the one side, you have this tremendous unpredictability. Well, Jeff Bezos said something that very obvious, very smart, but very wise. He said, when you get into the business of predicting the future, you're going to be more profitable and better off. Don't spend a lot of time trying to guess what's going to change, because you don't know. But if you can identify the things that'll stay the same, build your house on it, and you'll be fine. Mm-hmm. And so as you read this book, what I would do is on every single tragedy you go through, I would try to find what I would call a generalized principle. In other words, what part of this reveals a principle? Because a generalized principle is true in all cases, all climates, all ages. Gravity is the same today as it was in Galileo's time, as it was, back in the Garden of Eden, if you believe in that stuff. So wherever it is, it's the same, and it's going to be the same 100 years from now. So if you can go through Surviving Wall Street, A Triumph of Tales, Tragedy, and Time, or Triumph, Tragedy, and Timing, and identify principles that, okay, this is something that won't change and something I can learn, the Darwinian nature of people. I'll give you another example. You mentioned Silicon Valley Bank going down. Okay, well, why did they go down? Well, they're mostly in a to provide business capital. They're not so much a mortgage place. And people put money in the savings. That's a liability to them. What do they got to do? They got to buy bonds. You can't pay out on a savings, and if you can't lend the money out for VC, you got to have somewhere to go. So what's the safest place? Let's buy some bonds, and we'll get more money on the bonds than we're paying on the savings. Well, when savings is 0 point whatever, and bonds are a percent or two, that's rough. Well, all of a sudden you have inflation, you jack up interest rates. The value of those bonds are nothing now. You can't sell those at a premium. You got to sell them at a discount. And all of a sudden you see a few guys in the boys club say, if we pulled our money out of there, they'd have to sell their bonds. We've got them if we want them. And they said, yeah, let's do it. And next thing you know, Silicon Valley Bank goes out, and over the weekend, what's the Fed? They're going to try to fix it. Well, I told my son, I said, this is interesting because the Darwinian thing is the constant. And I go, let's go bank shopping on Monday, because people are going to lose their freaking minds. And the book value on certain banks, the price per book was like you could get 50 cents of price for $1 a book. Now, banks run a little hotter. Their debt to equity is usually a little higher because of their business, but it's not that bad for them to run that hot. So if you can learn about how when a tragedy comes and see the opportunity in it, then, yes. I mean, my son picked up some banks, and he's a high school kid. Those prices have doubled because we understood the Darwinian reaction to that.
Right. Yes.
And then we went to fundamentals to find the detachment that was there. Last thing I'll tell you is on why you read this book. We are, in my opinion, irrationally exuberant. Things are priced in. Oh, tariffs are a nice excuse to get back in line with something when there's uncertainty. All that 9% drop with the tariff stuff did was tell you how ready Wall Street is to bolt, because they know they'll stay in it while it's rising, but they really showed their hand of what they really felt about owning equities if we have a little uncertainty. So, and the Fed doesn't fix stuff. The Fed postpones things. If you look at the Federal Reserve balance sheet in 2007, and then in 2009, it doubles. That's not normal. And if you look at it today, it's up 600% since then. So, and where that money isn't cash in circulation. It's member banks getting paid and putting a floor on interest rates. So you learn these things from reading a book, Surviving Wall Street, Tale of Triumph, Tragedy, Triumph, A Tragedy, and Timing. you do it to learn how to deal with tragedy, because we're going to have tragedy and there's opportunity in that's huge. I'm so excited. I can't wait for the everything bubble is what they're calling it. I don't know. I hope it's there, because when it falls, man, I'm going to acquire Warren Buffett, who hates cash, has $300 billion sitting there.
Yes, he spent all late last year piling that up. We'll see where he gets to use it.
He's not been wrong too often. Sometimes, but not wrong. Scott, wonderful to speak with you. Everyone go out and I always sell books the same way. I said, if you could take Scott out to dinner and bend his ear for a little bit, would you pick up the tab on the steak? And you probably would. Well, that steak could cost you a lot more, and you'd only have an hour with him. But if you guys like this put their heart and soul in these stories, and you will get far more value for a few bucks, much less than the steak, going and checking out Surviving Wall Street: A Tale of Triumph, Tragedy, and Timing. So with that, Scott, I thank you. Hope you've enjoyed our conversation. Go to yourinvestingclass.com to learn more. I think, Scott, that's a good 1-2 punch on this episode. Scott has some great experience in understanding macro stuff. I'm not bad. I'm not the best, but I'm not bad at seeing that stuff and knowing how to translate that into a trade and into a position, which is a nice skill. It's a nice 1-2 punch to have. Thank you for your time, sir. Please hang out for a bit so we make sure the video uploads, more importantly, so I can thank you, Scott, after we close. You've been watching and listening to the Cashflow Academy podcast. This is where we make investing a lot of fun. We make it simple and always keep it real. We'll see you next time.